Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you at Global Alts in Miami by iConnections, and joining me for this segment, we have Nazarian, Managing Director and Assistant Portfolio Manager at Private Assets at Oaktree Capital Management. We're here to discuss how the global alternatives investment environment continues to evolve. Lars, it is great to have you with us. Welcome to Trade Talks.
Thank you for having me on the show.
You got it. And we hear a lot about the growth in global alts, particularly in private credit. Where are you seeing opportunities in this space right now? Because Oaktree is known for the work that they've done in private credit.
Yeah, thank you very much for this question. Look, it's if you take a step back and look at the economy and the markets, pretty resilient. Looking at an environment where a higher interest rate for longer is the theme. Not expecting too much decline from there, but you never know. However, there's a number of inflationary policies that leads us to believe that it's going to keep higher for longer. And in this environment, it's good to be a credit investor. Mm-hmm. And we're seeing a number of places where this could be very interesting. Notably, this is a large market, private credit, high yield, BBB bond rating. The corporate lending landscape is very large right now. It's probably $12.5 trillion compared to 2007, where it was only $1.4 trillion. So even a blip in terms of stress, even in a benign environment, will lead to some opportunities on the opportunistic side of things, where the stresses will start to percolate. But in performing credit, which is the remaining of the large market, we see a lot of appetite for credit from investors and demand from different pockets of capital, borrowers, private equity sponsors, and other parts of the capital markets.
Let's talk about asset-backed finance for a moment here. We know that your traditional lenders are facing those headwinds. Do you believe that private credit and the migration there from asset-backed finance toward alternative capital markets, do you think that's going to be a trend that continues?
I do. We think that this is a transition that's going from really a bank-heavy lending area to a non-bank lending area. And historically, you had really two types of players in the asset-backed finance business, which are contractual cash flows. Right. You had the banks and the insurers on one side, focusing on the lower risk, lower return of the spectrum, and you had the equity, right? The opportunistic crowd, private equity-like, focusing on the higher risk, higher return. Today's banks are shrinking their footprint. And so that is leaving an in-between, which we call at Oaktree ABF Core, which is this area that banks are leaving or shrinking their footprint in, that insurance capital cannot go because of the lack of an explicit investment grade rating, right. But it's too low, or there's not a path to this higher return that this opportunistic crowd is looking at. And this is income generating, it's high cash flowing, it's differentiating from a private credit allocation perspective because it provides a lot of cash flows as opposed to relying on refinancing at the maturity of your investment.
Right. So it sounds as if the macro environment certainly has, it's a big player. It has a big impact in the space, let's put it like that, which is why you're seeing the retreat from traditional lenders and with a higher interest rate environment. Because of the cash flow, that's what's going to make the product more attractive to investors when you're thinking about allocating.
Yeah, look, the fundamental question in asset-backed finance is, will the borrower or the person or the individual in the company behind that obligation to pay is going to pay? Mm-hmm. In traditional corporate or real estate lending, you're asking the question, what is it worth? So this fundamental question, right, is different, and it can be disorienting to the traditional credit investor. And we think that by creating this differentiating cash flow profile, that will help investors diversify within a credit allocation with cash flows, but also across a number of sectors, a variety of asset types.
And that's what I was going to ask you. Is it sector specific? Are you agnostic? What are some of the parameters you're thinking about when you're going to make an investment within this?
At Oaktree, we've invested in asset-backed finance across a number of sectors for the past 20 years. And our strategy really to tackle this new opportunity and income is really to be able to have a diversification across sectors, but also across investment we make within a specific sector.
Right.
Because we want to keep a relative value lens across these different sectors, but also minimizing the number of correlation factors that will be common to all investments so that it doesn't impact all your investment alike. Right?
So for an example here, aircraft leasing was one of the sectors that you had mentioned. Why or why not do you find that an attractive area?
Well, aircraft leasing is aviation in general is a very it's attractive right now because there are strong fundamentals, right? You have the OEMs that have not been able to output the new plane, so you have a lot of demand because of travel is up, and you have more demand for mid-life aircraft, for instance, which increases the value of the planes, but also of the leases attached to it. And airlines need those aircraft to face the demand for travel worldwide. And so the fundamentals are attractive, and you can be a lender in mezzanine, for instance, or buying some of those aircraft leases and leverage them, depending on how comfortable we are with the underlying this class, to have a very good relative value investment in the space.
What about consumer credit?
Consumer credit? Yeah. Well, it's a little diverse, I would say, and there's not, there's multiple ways of and the demand from specialty lenders in the consumer space. Not all lenders are alike. We are coming from a pretty low unemployment stage, right, at 4 and change %. Right now, the likelihood of that going up is probably 200 basis points. It's probably higher than it going down 200 basis points. So you have to pick your spots in there and be careful on how you're constructing. The consumer lending we've witnessed and observed that the delinquencies are probably higher in some areas where you're not facing a real person or a point of sale effectively. Whereas, looking at getting a consumer loan online, there's more propensity for consumer to pay in the former than in the latter. So we're picking our spots. We're careful in the space because obviously, there's been a fooling of some of those models, in 2020, 2021, with a lot of the governments spending and putting money in the pockets of savings for consumer, and having this delinquency rate going up after this was shut down and those savings had disappeared.
Right.
So we're careful overall, but there are spots where we think that the capital needs can be met with downside protection.
But overall, ABF is not a short-term opportunity. It's something that you see longer term. It
is absolutely longer term. Look, this was really driven by banks shrinking their footprint in the space. And banks have started really shrinking overall since after the great financial crisis started with Dodd-Frank, and that gave birth to the private credit direct lending market. So we are at ABF stage today where we were with corporate direct lending back 12, 14 years ago. And with this pool of new capital that is rating insensitive, is going to be a good complement to where the banks want to stay involved when they want to stay involved, and have a very good ecosystem to really go in front of the capital needs for specialty lenders in the industry across multiple asset types.
right, Loris, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from Global Alts. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.